Welcome to the weekly intermarket analysis video update. I go through a number of different areas that I'll cover here in just a moment, but this looks outside of the S&P 500 to see if we can get some clues as to what's happening in other markets and how they may impact the S&P itself. This is being prepared for Monday, April 28th. The areas that I'll cover first are valuation. Now that applies to the S&P. There's a few other indexes thrown in there, but mainly what we're looking at are past valuation models based on earnings reports that have already come out, and then looking forward to forecasts and projections as to what the actual earnings reports will be off into the future. Then I do a pretty extensive look between growth versus value. In a positive environment, we want growth to be outperforming value. When value outperforms growth, that means the market is underperforming, getting more defensive, and likely starting to go down. Then we look at inflation, and there's a number of different ways of looking at this throughout the different slides that I'll show. We look at other markets that are outside of the stock market, areas that we're not really involved in, but we just want to keep an eye on these markets because they might have an impact. Then I break down the 11 S&P 500 sectors. First, we look at the sector by itself, and then we do a ratio between how is that sector performing compared to the S&P 500. We look at a lot of different indexes. Most of these have to do with stocks on different areas of the market, and some we compare with the S&P itself. Then we look at correlations. How is the S&P holding up versus other markets? Then we look at some very long-term trends. And then at the very end, I have a positive list and then a negative list that we go through. First of all, looking at valuation. This looks at historical earnings reports that have already come out and then does a ratio with the price of the S&P 500. And even though we've been coming down, we're still well above this red dashed line, which is a PE ratio of 20. Anytime we're at 20 or above, the market is considered to be expensive. We would have to come all the way down to 4,200 just to get down to the expensive level here. This is that same thing going back to 1980, different events that have happened and what the valuations were at that time, and then looking at what the valuation is right now. We also look at a variation of this with the Shiller PE ratio. This looks at earnings spread out over a 10-year period of time to get rid of any outliers or one-time events. And right now we're coming in at 34.22 with the PE ratio. That's expensive, but we can also compare that to the median and the mean, which over a period of time going all the way back to the 1800s, this is between 16 and 17. So even though we've been declining, we're still over double what the median and the mean are currently showing us. Now this looks forward. These are forward-looking PE ratios, and this is what the stock market uses. The purple line that you see here is the mega cap 8. And even though we've been coming down, we got down to 22. Well, this past week was a positive week, so we're seeing this PE ratio going up. And we did fall down almost to 18 with the S&P 500. That's the red line. Well, since it's been going back up, we're getting to a reading right now at 20. So it's considered to be right on that border of being expensive. If we continue to go up from here, it'll become even more expensive on a price to earnings ratio basis. Then we look at the mid caps and the small caps. Those are in green and in blue, and they're bumping up a little bit with the rest of the market, but they're still coming in under that 15 level. So they're still at the lower end of the fairly priced model, where the mid caps are coming in at 14.3 and small caps are coming in at 13.8. This is another chart that I ran across during the week. This is also looking at what is the current PE ratio versus what is the range over time, where we still have the NASDAQ 100, and that's pure growth. Even with the declines, even though we're in a downtrend with the NASDAQ 100, we're still coming in with a PE ratio of 24, where we should be right around the 20 level. Now, this is one that I don't agree with, and every time I see this chart, I have to bring this up. The Russell 2000, these are the small caps. Now, on the previous chart, I just showed you there at 13.8. This has us at 22, which means that they're still over that 20 level and considered to be expensive. But I don't necessarily agree with that with how this report shows it. The S&P is right at 20, and that's the same as what we saw in the previous chart. Then there's an equal weight version of the S&P that treats all the stocks the same, and it's mainly the big stocks, the mega caps, that really are overvaluing the S&P and bringing us back up to 20, where if you look at the equal weight, that is coming in a little bit above the 15 level at 16, and then mid caps. And this is pretty much where I'm seeing small caps as well. I'm not sure why. We've seen this many times here. It should be down in this 14 to even 13 range. And we do a look at growth versus value. First, we look at growth all by itself, which is now in a downtrend. But over the last week, it's been bouncing back up. We're going to need to get above this blue line, which is a 50-period moving average, and the red line, which is a 200-period moving average, and then stay above that to see the trend turn back up. But when we look at growth all by itself, it's currently in a downtrend, but improving. Even value has been taking a hit lately, but it's been holding up a bit better. It's still hanging on barely to an uptrend as well. Where we get some insight is when we do ratios between growth and value. And even though we're hanging on to an uptrend with growth outperforming value, this has been pretty weak lately, but we have been bouncing back up. Down below is an inverse of that same chart showing how value is underperforming growth, but it has been coming on strong lately. If we see this crossover and if we see growth really underperform and value outperform, that means the market's getting more defensive. And I really hone in on that in the daily videos that I do. And when we see that happening, that's when we get concerned that the market's getting ready to go down. We look at growth to value in a number of different areas. Here's an ETF where we're just about ready to see a death cross here with this growth to value ratio. We're just about ready to see a golden cross with this other growth to, or this is a value to growth ratio. And then we look here, we're actually starting to drop below it. We've already generated a death cross with this growth to value ratio. Here's a value, another growth to value ratio, hanging on barely to an uptrend. This is barely hanging on to a downtrend, showing how value is back to underperforming, but we need to see this continue to go down to be more positive. Now we look at small caps, which are still hanging on to an uptrend, but we have been seeing an improvement over the last few trading sessions. Also an improvement with the mid cap growth to value ratio. And we're in a downtrend with the S&P growth to value ratio, but we're starting to show some improvement. We're going to need to see more follow through for this to turn back positive. And we look at a growth versus a value ETF and do a ratio. We're coming up right to the other underside of this rainbow. We need this to go up if that's going to be more positive. Now, this coming down, that's positive, but if this ratio with value to growth continues to go back up, that's going to be more negative for stocks. Then we look at inflation. I have a monthly chart of the CRB index where it's coming down, but we're still seeing the red line, which is the moving average based on 12 months. That's still in an uptrend, but the market doesn't seem to be really concerned about inflation right now. We are coming up here with the inflation to deflation ratio, but we're still under a declining moving average. But this is a longer term chart. It's based on a month. This is a daily chart. And we pulled back with commodities, but we're still in an uptrend. This going up could cause some concerns in the market that maybe inflation's coming in because these are all the different components that make up the CRB index. And if they continue to go up, that could ultimately lead through to prices which are inflationary. Baltic Dry Index, it had been coming up. Now it's starting to come back down and it's still in a downtrend. This is another inflation gauge for how much does it cost to ship products in the Baltics. This coming down is more deflationary than inflationary in a general sense. Inflation expectations, they've been declining since the beginning of 2025. Well, now they're starting to go back up just a little bit, but we're not really seeing a breakout of this recent range. We also look at inflation expectations and do a ratio with TIPS, which I'll talk about more later, which are Treasury inflation protected securities. This is the vehicle or vehicles that people get into when they're worried about inflation going up and interest rates going up. We're not really seeing much of a change with this overall ratio right now. And we look at aluminum, which is in a downtrend. Corn is still in an uptrend. Wheat is in a downtrend. Fertilizer is coming up a little bit, but not really spiking up the way we saw it back in 2022. Lumber is in an uptrend, but pulling back, actually getting close to its 200-day moving average. Oil has actually been going down and it's in a downtrend. And we watch this not only because it going up, that means our gas prices are more, but we also watch this for geopolitical reasons. If there's a lot of tension in the Middle East, oil has a real tendency to spike up. But for right now, it seems to be behaving. We look at a ratio between gold, which has been going up, and oil, which has been going down, and overall this ratio is going up, meaning gold's outperforming. Then we do a correlation between the 10-year yield, which is in black down here, and then oil, which is the red dashed line. And we see that they're having a slight tendency to go in opposite directions, but they're pretty near this neutral area right now. Heating oil is in a downtrend. Natural gas, it's in an uptrend, but it's really been pulling back lately. And then gas is kind of in an uptrend. It's been chopping around a little bit here, but not really going up with a lot of conviction. Diesel, we still see this falling for the most part. And then we look at copper, and it's nice to know what's going on in this market, but this actually tells us a little bit more. When copper's in an uptrend, and that's what we're seeing on the weekly chart, and we're seeing it here on the daily chart, and it's been volatile lately, but this is a barometer of the economy. And if the economy was getting ready to fall apart, copper would be in a downtrend, not in an uptrend like we're seeing here. And we look at a copper to gold ratio, which is bouncing back a little bit, but this has really been coming down. Now, copper's been doing well, but gold's been breaking out as we're dealing with all this insanity and uncertainty with the tariffs and trade wars and things like that. So that's why we see this ratio really going down. The fact that it's bouncing back up a little bit, it's encouraging, but it's going to need to really go back up to be more positive. This is a longer term look at that same chart where we're seeing really a disconnect between the 2-year in green and the 10-year in red as the copper to gold ratio has pretty much been going down. Typically, they don't get all that far apart from each other, even though they're on different scales. They are rolling over a little bit, seeing an overall decline here, but this is strange. This isn't what we've seen over the last number of years, but we've been watching this disconnect for a few years now, and it's not really telling us anything. We don't really know what to conclude from this. Gold just set a recent all-time high, but it's been pulling back. What I follow here is the gold ETF, not the futures price for gold. Silver is also in an uptrend, but not back to its all-time highs. We do a ratio between the closing price for gold and silver, and we can see, even though it's coming down, the correlation between the two is pretty strong. Gold and silver usually go more hand in hand with each other. And then this is an interesting study. We do a gold to silver ratio on top. And when this is going up, that means gold is outperforming. And then we plot the US dollar index and then do a ratio between the two. We're actually seeing them going in opposite directions, where most of the time we see a strong correlation that they're going in the same direction at the same time. And this is some of the upheaval that we've been seeing lately because of the tariffs and the trade wars. The dollar, which has been weak, which is strange because with tariffs, that's seen as protectionist. And this is why the dollar was going up, was all of these tariffs were going to kick into gear. Well, now it's starting to come down. There are rumors out there that there's some manipulation going on here because typically the stock market likes a weaker dollar. And then we look at the euro to the US dollar. The euro's now in an uptrend and really been outperforming. And then we look at the euro just a shot up here, and you can see that it's pretty much a mirror image. It's like this is the mountaintop and this is the reflection on the lake. The euro is the biggest part of this overall US index here for the US dollar, and it's been going down. The US dollar index has, as the euro's been going up. Then we look at the Japanese yen, which has been bouncing back up compared to the dollar. Here's the euro against the US dollar index. And the Japanese yen, when you break it out, is in an uptrend against the dollar. The British pound is in an uptrend against the dollar. Then we look at some index ratios. This comes and goes out of the daily video, but we're not really seeing much of a disconnect now when we look at the weighted version of the S&P, which is the bar chart. And that's the one that everybody hears about, and it's weighted more towards the bigger stocks, and they have more of an impact. Well, to be a little bit more fair, there's an equal weight version of the S&P, which treats all stocks the same, and they've been coming back up lately. We see that the S&P has been outperforming just a little bit. Even though they're on different scales, we can kind of see what the overall performance is here. We look at a ratio between the equal weight and the weighted version of the S&P, just kind of chopping around a little bit, coming down recently as the mega caps and the really big stocks finished out the week looking stronger. We look at a ratio between stocks and commodities. This is showing that stocks are underperforming commodities. Here's an inverse showing how commodities are outperforming stocks. We look at the NASDAQ 100 on a ratio basis with the S&P. It's been bouncing back up a little bit, but we're in a downtrend here. The NASDAQ 100 is pretty much growth, and that's what's been getting hit lately. That's why this ratio is going down. The S&P is balanced between growth and value, so it holds up a little bit better. But if this can bounce back, keep going up, see the trend turn and go up, that means that the NASDAQ 100 is leading the market again and is more positive. It helps all of the indexes to go up. But we're not seeing that yet. And we don't know if this is just a bounce before we get ready to go back down or if we're seeing a genuine improvement. The S&P 100 is underperforming the S&P 500, and it's coming all the way up to its 50-day moving average here. Then we look at a ratio between the NASDAQ and the S&P 500, and the NASDAQ's been underperforming for a lot of 2023 and into 2024. The NASDAQ was outperforming the S&P. NASDAQ, again, is mostly growth, where the NASDAQ 100 are the 100 biggest growth stocks in the NASDAQ. Well, this is continuing to come down. This coming back up is showing a little bit of a bounce here with this ratio. The NASDAQ 100 is outperforming the NASDAQ. Now, both have been getting hit. The NASDAQ was the first to cross into a downtrend, a long-term downtrend. And then not too long ago, the NASDAQ 100 also went into a downtrend. But on a ratio basis, the NASDAQ 100 is holding up better than the NASDAQ. We look at the mega caps, which did well later in the week, and compare it with the equal weight. This is in a downtrend, but we're starting to see this bounce back. Small caps not doing well and really underperforming the S&P 500. Here's another look at that. The red line, that's the ratio between small caps and the S&P compared to the S&P itself, which is in blue. And small caps have been struggling. Tech's doing better, but we're just kind of chopping sideways with this overall ratio. Robotics and AI really getting hit, trying to make a comeback here. And when we compare on a ratio basis, the robotics and AI ETF with the tech sector, it's actually underperforming. Tech has been doing a little bit better. And here's another AI and tech ETF, which is just starting to give us a death cross here with this ratio. The blue line's just starting to drop down below. Now, if we continue to see more strength here, we could change that, but we have to go with what we're seeing right now. Low volatility. These are the stocks that folks get into when the market's getting more defensive or when it's getting ready to go down. This is still in an uptrend. And when we look at it on a ratio basis, for most of 2023 and 2024, the low volatility stocks were really underperforming. Well, now they're starting to outperform, even though they've been pulling back over the last few trading days. Energy to tech. This is seeing a change here where energy on a trend basis is starting to outperform tech, but now energy has been falling back. So we'll have to see how this ratio ends up playing out. Growth stocks versus bonds. We're seeing the bonds are actually starting to outperform. We're seeing a death cross here, but we did see a little bit of a bounce up. The tech sector to the 10-year yield shows that the tech sector is underperforming the 10-year yield. This is showing that the 10-year yield is outperforming the tech sector, even though it has pulled back on Thursday and Friday. Discretionary to staples, this is another growth area, but we're just seeing a recent death cross here. We need to see more improvement from this for things to turn back more positive. Staples had been underperforming discretionary, bouncing back up, but now starting to come back down. But they're in an uptrend compared to discretionary. Gold has been really outperforming the S&P, but it has been pulling back. Gold was declining, the S&P was going up, and so that's why we're seeing this ratio coming down. And we're seeing a little bit of a pullback with gold going down, but the dollar, it's been holding up, but still under 100. That's why we're seeing this ratio going down. Then we look at the advanced decline line. I do show this in every daily video. We're just barely above a declining moving average with the NYSE common stock, looking a little stronger, and the moving average is a little more flat with the S&P, also above a declining moving average with the mid caps and still below a declining moving average with the small caps. And we look at traditional Dow theory, which just looks at the Dow and the transports, and all have been getting hit, but the transports have been underperforming. Where the utilities, I include that as part of traditional Dow theory, where some pure Dow theorists would not do that. I do include it, and so it's going sideways here. So utilities have been holding up better. Then this looks at the Dow, the transports, and the utilities and puts them together. And because of weakness in the Dow and the transports and going sideways with the utilities, this is now showing a downtrend. We look at a ratio between the Dow and the transports. When this is going up, that means the Dow's outperforming. Here are the transports, which really have not been doing all that well. They might be setting up some kind of a base here, but we need to see more follow through for that to be more positive. Then a ratio of the S&P to the transports. This continues to go down as transports are underperforming, even though the S&P has been going down itself. We look at the correlation between the S&P and transports, and even though it's coming down a little bit, it's still a pretty strong correlation, just meaning that they're going in the same basic direction at the same time, either up or down. This is a new way of looking at Dow theory, where instead of using the S&P, we use, instead of using the Dow, we use the S&P. And it's been bouncing back up a little bit here. And then instead of using the transports, we use the NASDAQ, which has been bouncing up. This red line was a previous all-time high that was set earlier on that we don't see on the chart anymore. But this ended up being kind of a rough area of support for the NASDAQ. Then to break that down a little bit more, we look at the equal weight version of the S&P, which is starting to show some improvement, and an equal weight version of the Qs, which is the NASDAQ 100 ETF. That's also improving. The FANG index starting to generate a death cross. Now we're above both of these lines. These are the really big stocks. If this can continue to go up, that would negate this death cross that we're seeing here and help things turn more positive. Mega cap growth, this has been really going up strong. Now it's in a downtrend, even though it has been bouncing back. The Wilshire 5000, a broad market measure, showing some improvement, but still in a downtrend. Same thing with the total US stock ETF, improving, but in a downtrend. ARC just it's starting to generate a death cross here on the daily chart. It's hanging in there a little better on the weekly chart, but even though it's bouncing back up, this has seen some real weakness. We look at the all world ETF, which excludes US stocks. These are actually holding up a little bit better. They got hit too, but they've been bouncing back well. And then we do a ratio of the SPY to the stocks in the rest of the world. This is in a downtrend, just showing that world stocks have been outperforming so far in 2025. Another ratio between the S&P and stocks in Europe, Australia, Asia, and the Far East. This is longer term. This is a monthly chart. We're starting to come down below the 12 period, this is the 48 period moving average here. And the momentum is also going down, meaning that US stocks have been weaker than stocks across the globe. Then we look at bonds. This is the price of bonds, which has been holding up. We really shot up as interest rates were going down. Then we really came down as interest rates were going back up. It seems like we're stabilizing now. So at least over the last week, the bond market has been more under control. We're still in an uptrend with the total bond ETF. We're barely underneath just generating a golden cross here, which would mean an uptrend with the Pring World Bond Index. But it's still technically in a downtrend because the blue line's below the red line. And stocks are outperforming bonds. We didn't see that for the last couple of years. Now that's starting to change. We are seeing some weakness here, but this overall ratio has switched to positive, meaning bonds are outperforming stocks. This is a monthly chart showing how stocks had been outperforming bonds, but now pulling back underneath this 10 period moving average. High yield bonds, junk bonds, really got hit, showing some improvement. And that's more encouraging because high yield bonds or junk bonds tend to follow the stock market. Investment grade bonds, more high quality bonds, we're just about ready to see a death cross here as they've been really choppy lately. Stock to bond correlation means that stocks and bonds, stocks based on price, bonds based on price, are having more of a tendency to go in the same direction. Corporate bonds, still holding on to an uptrend and showing some improvement. Here, and I show this in every video, but we're really not getting anything from this chart. These are Fibonacci retracement levels against the 10-year yield. And we're also seeing how over the last few years, we've been establishing a higher interest rate range than what we were seeing over the last 40 years. Then the 30-year yield with some Fibonacci retracements were not near any of these lines. And then we compare stocks with the 10-year yield. When this is going down, that means the S&P is underperforming, but it is bouncing back now. Junk bonds, which also go pretty close with what the stock market's doing, they're actually getting back above their 50-day moving average. That's encouraging. And when we compare junk bonds with government bonds, this ratio is starting to go back up. And here's a daily chart of the different yields where they really spiked up, but lately they've been coming back down, and that's more friendly for stocks. A weekly chart looking internationally, we have US and UK rates, they've been falling. German rates have been falling, and Japanese rates have been falling as well. We look at the volatility of bonds as measured by the MOVE index, and as bonds have been going back up, volatility has been dropping off. The VIX is still very high, but it's been dropping off as the S&P has been rebounding, and the correlation between the volatility of bonds and stocks is pretty high right now. And we look at some ratios between the S&P 500 and short-term 1 to 3 year bonds. We're still below the rainbow, but trying to improve. And you're going to see a lot of that over the next few charts. The S&P 1500 to short-term bonds, below the rainbow, trying to improve. Broad market measure, 3 to 7 year bonds, under the rainbow, trying to improve. The tech sector to 3 to 7 year bonds, under the rainbow, trying to improve. Riskier bonds, junk bonds versus conservative bonds. This is also still still underneath the rainbow, but trying to bounce back up. And then we look at how bonds are now starting to outperform stocks. These are 3 to 7 year bonds. Now, over the last few years, bonds have been underperforming stocks. Now, it is coming down with this ratio, but for right now, we're in an uptrend showing bonds are outperforming. And then we look at the price of the 30-year bond, which is dropping further below this red line, which is a 12-month moving average. And we're also rolling over with the ratio between the long-term bond and commodities. So this is still showing some weakness, and this can take a while to improve since it's a monthly chart. Then I look at the different sectors individually. We look at materials, which are in a downtrend, trying to bounce back up, and they're underperforming the S&P. They're in a downtrend. Communication, this is a growth area. We want this to do well. It's still in an uptrend, even though it got hit with everything else, but it's back above its 200-day moving average. And it's actually holding up pretty good when we do a ratio between the communications sector and the S&P. This is in an uptrend. It's not that communication's been doing great. They've just been doing better than the S&P. Energy, which is just all over the place here. In a downtrend, but trying to bounce back up. But when we compare it to the S&P, it's back to underperforming, even though we've seen a recent golden cross with this ratio. Financials, and I say this all the time, we want the financials to do well. Now they're more cyclical. They go more with what the economy's doing, and the fact that they're going up is positive. But we also don't want to see a meltdown like we saw in 2008 into 2009. So this is looking pretty good by itself, and on a ratio basis, it's still outperforming the S&P. Industrials, more cyclical. That's in a downtrend, but trying to improve. And also in an uptrend, and they had been outperforming when compared to the S&P, but lately pulling back. The tech sector, this is their big growth area. In a downtrend, trying to improve, but still has a long ways to go. It's been underperforming the S&P. This needs to get above the red line and stay above the blue line here and eventually turn this more positive. Staples, this is more defensive. Toilet paper, toothpaste, still in an uptrend and outperforming the S&P, but pulling back over the last few sessions. Real estate, which is very interest rate sensitive, in a downtrend, trying to improve as interest rates have been coming down. And it's in an uptrend compared to the S&P, but it has been pulling back on a ratio basis. Utilities have pretty much been going sideways, and they're still in an uptrend and pulling back, but still in an uptrend when compared to the S&P. And we look at a ratio between the S&P and utilities. This is bouncing back up now, but for the most part, it's been going down, meaning the S&P is underperforming utilities. Then here's healthcare, another defensive area, which is in a downtrend, and it's starting to underperform. We were just about getting ready to see a golden cross here with this ratio, meaning healthcare would be outperforming the S&P, but now we're seeing some weakness. Discretionary in a downtrend, but trying to improve, and in an uptrend here and trying to bounce back when we look at a ratio with discretionary to the S&P. Semiconductors in a downtrend. And there's a lot of different ways I look at semiconductors, and all of them are negative, but we are bouncing back. This is a semiconductor ETF in a downtrend, but trying to improve. And then a ratio between the semiconductors and tech sector. If you notice earlier 2024, when this is going up, that means the semiconductors are outperforming. We hit a top over the summer and we started to actually go down with this ratio, but stocks were still holding up. And we went sideways going into the latter part of 2024, and then we've been declining most of the time here going into 2025. High leverage loans. This is encouraging. Another barometer of the economy. We fell down below the 200-day moving average. We're able to get back above that. And now we're still in an uptrend and we're back above the 50-period moving average. These are very risky loans. And this is used to say, okay, if the economy was getting ready to fall apart, this would be going down, not up. NYC composite been holding up a little bit better, but it's also below both of these moving averages here. We're going to see a death cross if things don't improve pretty quickly. This has turned over negative, all stocks. This looks at US and international stocks. They're improving, but now they're in a downtrend. Emerging markets really got hit, trying to improve and just barely in an uptrend. Micro caps, small companies, they are in a downtrend, but trying to bounce back up as well. And the Japanese Nikkei index, it's just been kind of hanging around this 1989 level here, but it is bouncing up off of its lows. Bitcoin, which is in a downtrend, and now it's starting to go up. You see that quite a bit. You'll see a cross of some kind here, not just for Bitcoin, but in a lot of different things that we look at. And then we'll just see a move in the opposite direction. Home builders, kind of neutral right now. When we look at the relationship between the S&P and the home builders ETF, not really getting any insight there. Then gold is the best performing asset so far in 2025, followed by the price of bonds. Commodities are barely positive. Stocks have now gone up a little bit here and barely outperforming the dollar. And now oil is the least best performing asset in 2025. And we're seeing some improvement globally. China's trying to turn up, emerging markets are turning up, Europe and Japan turning up as the US is turning up. And this is the KST, a longer term oscillator. And we look at some correlations between stocks and the dollar. Slight tendency to go in the same direction. And lately that's been down. But if this can bounce back up and the dollar can see a rebound, we would see this relationship get even stronger. The correlation between stocks and oil, still neutral. We're in this plus 0.25 to minus 0.25 area. That's when I consider it neutral. We're just coming out of neutral when we compare stocks to the 10-year yield. And we're also just coming out of neutral when we look at tech to the 10-year yield. And we're going into being neutral now with the S&P to the 2-year yield. That's shorter term. Then we have a long-term chart here. This is a monthly chart of the NYSE. It's been holding up better, but now it's starting to drop below its 12-month moving average. And the Copic curve, which is a momentum oscillator, is also starting to decline. That's negative. And here's a daily chart where we're trying to bounce back up a little bit here with the NYSE record high percent index after it had been declining. And we look at the S&P, again, a monthly chart here, starting to fall below its 12-month moving average. And we're also in a downtrend with the percentage price oscillator, a momentum oscillator. And then we look at the S&P on top, which has been showing some weakness on the monthly chart. And now we're seeing a longer term breakdown when we look at the ratio between the S&P stocks and commodities, the CRB index. Then we look at another global index coming down, but still hanging out above this red line. But the KST is starting to show some weakness. But this is another very long-term chart. It's monthly. Then at the end, we go through and look at those things that are positive. Value continues to be positive, as does copper. The euro, the British pound, and the yen, when compared to the dollar, are positive. The CRB index is positive. Gold and silver are positive. The FANG index, it's just there. If we don't see some more follow through upside, this will get added to the negative side for next week. ARC just hanging on barely to an uptrend, could be starting a downtrend. The low volatility ETF, toilet paper, toothpaste, it's in an uptrend. Staples, toilet paper, toothpaste, again, they're in an uptrend. And then when we look at bonds based on price, the total bonds, high yield bonds, investment grade bonds, corporate bonds, and junk bonds, they're actually hanging in there pretty well as bonds have been outperforming stocks. High leverage loans, that's encouraging to see that coming back and show some strength. And the NYSE composite, which is made up of a lot of value, that's been holding up better, and it's still in an uptrend. On the negative side, growth indexes are in a downtrend, as are the mega caps, the US dollar index, the Dow Jones composite, the tech sector, semiconductors, whether you look at the SOX, that's the semiconductor index, different indexes that we follow, and the ETFs. They're all going down. World Bond Index could be getting ready for a golden cross, but not quite there yet. And then we see the Dow, the NASDAQ 100, NASDAQ, mid caps, small caps, micro caps, and the S&P is on this list too. All the major indexes are in downtrends. And then we look at broad market measures, the Wilshire 5000 and the total US stock ETF, that's in a downtrend as well. Emerging markets, trying to improve, but not quite there yet. And then all stocks, that's a new addition to the list, which are US and international stocks taken together. And then Bitcoin, even though it's been bouncing back up, it's in a downtrend. Thank you. I hope you found this helpful. I hope you're having a great weekend, and I will talk to you in the next video.